Is this the calm before the storm, or is this just going to be calm all the way throughout the end of the year? Chris Vermeulen is back with us to join us to discuss this theme. He is the Chief Market Strategist at the technicaltraders.com. Chris, welcome back to the show. You're telling me offline that people usually take aggressive moves right before the top. Let's talk about that. Welcome back.
Yeah, thanks for having me. So, yeah, typically when people are most bullish and taking the most risk is usually when the stock market actually wants to go in the opposite direction. And we're starting to see that kind of across the board in a few plays. We're seeing last few days, we've seen the Russell 2000 perform fairly well, which are small cap stocks. We're seeing silver miners come to life, the ARK ETFs, uranium stocks, a lot of interesting stocks, volatile ones are really coming to life. And so that's usually a sign we need to be aware. When you look at, for example, the difference on dividend stocks have been struggling. Nobody really is moving into those at this point because they're kind of a boring play. And so when people get really bullish, even though I think from a technical standpoint, the market is struggling. It's not that strong, but people are moving into the aggressive plays, anticipating a bigger move to the upside. They want to profit. And usually when everybody does that, when we see this sentiment shift, usually the market kind of goes in the opposite direction and catches most off guard. So there's a bit of a red flag there across the different types of stocks that are moving recently.
If people are shifting towards an aggressive stance, that signals a sentiment shift coming up. Wouldn't you want to follow the herd in that case, though, Chris?
Yeah, I mean, there's no doubt the stock market trend is up right now. You should be long. The trend is up, so you've got to play with the trend. There's a difference between, I think, following the herd and like the overall trend. So a lot of times, like the trend is up right now and people are bullish. So you do need to be long. I think the sentiment is just a warning sign saying, okay, it seems like money is piling into this stock market, into the aggressive plays, and it's more so people who are kind of throwing risk out the window. They're swinging for the fences. They want big returns. A lot of people, I think, are very frustrated right now. The markets had the big sell-off. You and I talked about as the markets were putting in that bottom. I said, listen, we're ready for a big dead cat bounce. And then we need to see if it is going to roll over and go lower later, several months from now, or if we're going to break to new highs. A lot of people missed this big bounce. A lot of people aren't long and they're angry and they're frustrated. I have this inbox indicator, and I also follow a lot of different comments in search engine terms and things like that. People are frustrated and now they're just buying into stocks to be like, I got to get in something aggressive to make a bunch of money. And so usually when we see this sentiment shift and people get frustrated and more or less kind of greedy in a way, they're moving into fast moving stuff. That's a red flag on the market. So from a sentiment standpoint, I'm bearish. It's actually a bearish sign, but the trend is up. So you do need to follow the herd mentality right now. But I definitely don't trade off emotions. It's follow the trends, follow the price itself.
Can you give us some examples of things that people have been moving into that may signal this sentiment shift?
Yeah, I mean, if we could pull up the charts and take a quick look at in the precious metal space. So gold has been the leader for a while. And if we move over to silver, we can see silver has finally had this giant bull flag pattern that you and I had talked about before. I have about $38, 36, and then it was to $38 as the upside targets. Silver has now really popped and taken the lead. It's now breaking to multi-month highs. So silver and gold miners and silver miners are the leveraged way to play the precious metal space. Gold is kind of the broad barometer of fear, which has been moving up, but now people are like, okay, I'm kind of done with gold. I want to move into something that's explosive. And so people are moving into silver in miners. And when people move into the leverage, the aggressive plays within this space, so if we take a look at GDXJ, which are the gold miner juniors, they have broken this high from a couple of months ago. And of course, silver miners, SILJ, the juniors are rocketing higher. And these are the most aggressive ones. And so people are piling into the leverage plays. This tells me, yes, gold is in a bull market, so are silver and miners. But when they shift to the really highly leveraged play, it's almost like people buying like put options when everybody's buying, or sorry, call options. When everybody's buying call options and they're bullish and they're playing the aggressive side of things, usually the market's about to change direction. So the fact that they're tired of gold's been going sideways for really the last 3-4 weeks or longer. And now money's moving here is telling us that they're looking for big gains. And it also usually means we're very close to an economic reset. Typically, we'll see this whole space come to life just before some type of news or something puts a major top in the stock market.
So, and I think maybe another way we can look at it, because people have been telling me that that these asset classes move on their own timetable in the past. So, for example, gold has historically led silver and the gold miners. In other words, gold moved first, and then the miners followed. That's exactly what happened this year in 2025 when the gold miners started outperforming the bullion, and in 2024 they lagged. Silver as well, underperformance. Well, not underperformance, but it moved in tandem with gold throughout 2024, but you're starting to see outperformance now.
Yeah.
So typically we see these asset classes lag, and now once they're starting to catch up, you're saying that once laggards catch up, that is the market top. Usually, is that how it works?
Yeah, that's generally the way I see it in this particular market scenario. So, yeah, and the fact that now people are moving into the laggards, people are saying, okay, well, gold's had a big run. It looks like it's kind of stalling out, it's struggling. They're like, let's go find the ones that haven't popped and ran yet, which is silver and gold miners. And now they're popping and running. It's kind of a very delayed play. Yes, they have big moves, but I think they are very swift and they bring us closer to the end of that trend.
Okay. What do you think about silver right now? Let me just talk about silver for just a minute since you have that chart up. Silver has been lagging all year and has just recently shot up. Anything in particular that's signaling, or is that just overdue for a breakout, you think? And we can talk about its technicals.
Yeah, silver I think was just overdue. I think if using Fibonacci extension, we've had this nice run up and this pullback. You can see silver just based on Fibonacci has it hit its 618 perfectly. Usually if we hit this 618, which is called the golden ratio, and you pause for a bar or three or a few bars, then we almost always go up and hit this 100% measured move. I think you and I think actually drew and talked about this on our last talk several weeks ago, 3 weeks ago or so. Silver has made that move. If we zoom out on this chart, each time we have one of these huge rallies in silver, we tend to see like a very strong pullback right after. It's a very emotional commodity. It's dormant for a while and then boom, it pops and it shoots up and then it eventually kind of tops out and pulls back and it rinses and repeats. So to me, silver has just had that measured move. We could stretch it to go for a bit more if people want to be like overly bullish. You could say, okay, well, if we actually go to the spike low, it's showing we could go to about 38. But the conservative play is done. This was the bull flag pattern that formed. It broke out. It hit the 618. Now it's hitting the 100% measured move. This to me, it feels like it's going to be one of these standout highs where there will be a big pullback after. And yeah, so that's how I see silver. I think that kind of easy money from that bull flag pattern is popped, and I wouldn't be like thinking it's going to 50 or 100 or anything. This to me is just a reaction high. It's this sideways pattern. The longer something trades sideways, the more power it builds for it to pop and push. And this really was a pretty nice pattern that's just played out.
I'd like to take a minute now to talk to you about a great way to buy physical gold through a trusted dealer. Our sponsor today, One Gold. Launched by trusted industry leaders in AppMex and Sprott, One Gold allows you to own vaulted gold, silver, and platinum in your choice of secure vaults around the world. With One Gold, your holdings are fully insured, audited, and IRA eligible. One Gold is an intuitive and secure alternative to precious metals ETFs and offers an array of unique investment tools like the bullion card, auto invest, limit orders, and more. Thousands of customers are using One Gold as a complement to their physical assets using their regular at spot promotions. Additionally, One Gold offers unparalleled liquidity with same or next day cash withdrawals, 24/7 trading, and physical redemption. Get started today with a few clicks from onegold.com, link down below, or scan the QR code here, or by downloading the One Gold mobile app in the Google Play or App Stores. Do you think silver will outperform gold for the rest of the year? Just looking at the technicals.
I don't. I think gold is going to hold up. I honestly still feel that gold is going to stall out and roll over. I think, and so will silver. And I think eventually we're going to see silver will be down more percentage points than gold, just because it moves a lot faster. So I think gold is the still going to outperform at this point and hold more value than silver will.
So that is an interesting remark. Let's go back to the stock markets now because we were leading into things that move differently in a way that may signal market tops. So if we're to expect a market top, the S&P is trading at 6,000. It's just retested 6,000 this morning,
Yep.
Chris. Where can we expect this rollover to happen?
I would say this rollover should be starting to happen somewhere right up here. I think we could potentially push a little bit higher. I think somewhere between where we are right now and maybe just breaking to new all-time highs nominally for a few days or something. I think we're in this zone for the market to roll over. Obviously, Tesla hit the markets yesterday and really took the wind out of the sails with Elon's comments and Trump going back and forth there. But overall, I believe we're in this, like, there's not a whole lot of upside left before we roll over. Actually, if we take a look at the sentiment chart for the stock market, if we look at the S&P 500, here we are at the bottom. You can see June. Well, here we are at the end of the first week in June. Typically, this is where the stock market, they say sell in May, right at the end of May, and then go away. We go into kind of the summer doldrums. The stock market naturally has a bit of a sideways and downward bias. So we are kind of in that nosebleed territory. The S&P 500, the NASDAQ are both right up near all-time highs. Seasonality wise, we're running out of steam. We're seeing increased volatility in the markets in terms of news coming out and just the way the prices has been kind of if we take a look at this top zone right here, I'll just kind of draw a box of all this price action through this high. We carry that over. We're getting volatility in here, big intraday wicks. And so we have to expect the market to stall out here. That is kind of the scenario at this point. And I think we're getting close. But in a perfect world, I'd like to see this move up a little higher, simply because the trend continues to be unfolding, and we've got some targets to the upside to be able to lock in some gains. And it's really interesting. I have this sentiment chart. So, for example, if we take a look at the QQQ, this is the daily chart on the left of the QQQ, and our strategy says, hey, something's happening in the markets, get out. We were able to avoid the big market sell-off, actually, and move into a position to build our capital as the market's going down. We got back into the market. It's hit our first target, and we are actually just about a half a percentage point away from another target, about a 10% move. So in a perfect world, we see this stock market move a little bit higher. It's going to come right up to all-time highs, create a double or triple top, and then we see a big sell-off. And the sentiment here, this right chart is our sentiment chart. So I take, David, a ton of data through about 11 different asset classes and money flows and ratios, and it tells us when the sentiment is starting to change. So deep red is, a very, very negative sentiment. And right here is where we had enough negative sentiment saying, get us, out of the market. That was our trend exit. And now you can see we got these deep green bars, which is very, very bullish. We got another deep green bar today, and we're up at resistance. So sentiment right now in this scenario is really bullish, but the underlying technicals are weak. The retail, this focuses on more so retail investors, this sentiment chart. So retail investors now are really bullish, and the technicals are actually really weak. So this to me is still, I call it a dead cat bounce. It's a huge one. But we're still, from a technical standpoint, I believe this is going to stall out and roll over and become a major double top or something in the market. So this is the scenario we're in, is people are getting bullish, and the technicals are not supporting it. The technicals are saying we're going to see some big selling, and selling is going to drive it lower. But you definitely can't fight this trend.
Well, signals that we can use then as traders to show us that the market is definitely rolling over, and it's not just a short-term correction. Because you can have days where Trump, let's say, opens his mouth and says we're going to have tariffs again, and the market drops another 3%. That may just be a short-term correction, and we've seen that over the last couple of weeks. So how do we know definitively that we're in a new downtrend? Like, how much does it need to drop for that trend to be confirmed?
Yeah, so what we need, when you look at the markets in general, you need the market to stall out and go sideways. So what we need for the markets to reverse is for this market to continue to trade sideways long enough that this upward trend is now actually sideways. Once something has gone sideways long enough, it loses some of its upward momentum. And then as soon as it starts to move down a bit, that'll be us from a technical standpoint saying, okay, it's gone sideways and now it's starting to go down. Price action is still the number one indicator to follow. You wait for price to actually turn down and then you exit. It's not about trying to pick a top and saying, "Oh, I'm out. I nailed the top." It's about letting it top, letting it sell off, and giving back some of those gains, knowing that's part of the game. And then once it's proven that, okay, this is going down, the money's flowing out of the stock market, then we get out. So the number one indicator is we need to see price roll over and sell off. You said, how much does it have to go? It really depends on how quickly the market moves. For example, if it was to trade sideways here for another week or two, we might actually get a trend signal to change, more or less right where it is right now, for all we know. It could actually just lose its upward momentum without giving back price. But if it was to sell off and drop really quickly here, it might actually take, 2, 3, 4% for the market to actually confirm that it's broken down momentum wise, and then it would probably continue to sell off from there. So again, everything is always very dynamic. It depends on how quick that move happens. If it's dragged out, it might not lose much value at all. It just might, the trend might end. If it drops quickly, then we're going to have to give back a few percentage points and exit once that trend is turned down.
I see. Well, Chris, let's take a look at the 10-year yield. It's now approaching 5% again. And, we've seen some decoupling between the 10-year and the S&P 500 earlier in April. And now it seems that things are recoupling. So any signals here that we can draw from?
Yeah, I mean, the reality, like when you just look at the charts, if you can get everything else out of your head that's news, and high interest rates will break the US, and if you get all that out and you just strip it down to the charts, this chart is still a very, very bullish chart pattern. It is either right now putting in a major topping phase, or it has got a bull flag pattern, and we're going to see rates go a whole lot higher. People start to lose faith in the United States and trust, and yields have to go up, and everything moves up because people want higher yields if they're going to take on risk with US bonds and things like that. So right now, at this point, I think the best case scenario is yields are going to keep trading sideways. Worst case scenario is we see yields really take off. And obviously that is going to play a big role in the bond market. And it's going to show that probably hurt the dollar. I think that'll mean people are losing faith and trust in the United States. They're burning bridges. So at this point, interest rates look strong. I don't think they're going anywhere anytime soon. They have a very strong chart pattern that whichever way it breaks out of this is going to be a big move. So rates are either going to drop, I think, pretty sharply, which I don't really see happen, or they're going to break to the upside and have a push, and it's going to cause a lot of damage, which could very much so be the scenario that unfolds. And most people, I don't think that's going to happen. They don't want it to happen. It'll definitely do a lot of damage, but sometimes things like that will happen, right? And that's what the charts are pointing to, is higher yields, and it's going to wreak, I think, havoc on a lot of sectors in the stock market.
How are you positioned now? How much of your portfolio is in cash versus in the markets?
We are 30% in the equities markets. We were 60%. We've sold half of that position. And so now we're 70% in cash, just collecting interest. And the rest is half in the SP 500. The other half of that 30% is in the QQQ.
And you probably get this question a lot, and I've asked you this before in the past as well, but why not go all in and all out at any given time? So let's say you're trading momentum and you think that the market is still in a bullish phase for now before things roll over. Why not go 100% until you see, like we talked about earlier, definitive signs of a rollover?
Yeah, so if volatility has increased, we've got all kinds of chaos in the markets based on this theory and strategy that you and I have shared many times before, that there's 4 stages to the markets. Based on our technicals, we are in a stage 3 topping phase. Most stocks are struggling, nowhere near the highs. We've got high interest rates that look like they want to go higher. We've got economic data not looking all that strong. We've got uncertainty going on with tariffs and politics and all that stuff. So we're in a stage three. And when we are in a stage three environment, typically there's chaos and there's volatility. One sector's hot one month, the next month it's not. When the markets are like that, they carry more risk. When there's more risk, we step back and we make sure we have a reserve in cash. We don't want to go all in because it's much more of a coin toss in a stage three if the trade is going to work out or not. And so if there's a lot more risk, we don't want to risk as much. It's not about making as much as you possibly can. It's about growing our money when the market is in a good condition and it carries little risk and there's high probability of making money. And then when the market is risky, we want to step back and just preserve our capital, preserve our lifestyle, and just wait for another setup. So there will be a time when we want to go all in on the markets, which is a stage two, which is a bull market phase, which we're not really in, and a stage four, when the market is collapsing in free fall mode and falling month after month. That's when you can put on some bigger trades because they have momentum. They have real clear direction. It is like money either pouring into the stock market in a bull market or money like vaporizing and getting pulled out of the stock market quicker than most people can imagine. And the prices are falling. So when there's strong trends, David, that's when we go 100% in and out. But in a stage three or a stage one, which I shade red and orange, they're choppy, they're dangerous, they're more of a coin toss. And that's when you need to sit on your hands a bit more and just enjoy life and hold out until we're in a prime condition to really swing for the fences.
How long do these consolidation patterns usually last? Is there a pattern that you've established?
Do you mean for like the overall economy in terms of stages or?
Let's just take stage three, for example. Right now, the market is in a consolidating pattern. It's waiting for a breakout, either up or down. How long does that consolidation last?
Yeah,
Or how long could it last? Yeah.
yeah. Well, it can last years. I mean, it can really drag out. Generally, I don't want it to last years, but if we take a look at this particular group of stocks, so this is the equal weighted S&P 500. It's the small caps, which is Russell 2000, and the micro cap. So this is stripping out the big mega techs and putting an equal weight on the large, the small, and the micro caps. We have really been in this kind of topping phase for the general stock market, all the way back. I mean, it more or less kind of topped out back over here, 2021. So we've been in this for a long time. If anybody has a bunch of stocks in their portfolio, they're really not trading near the highs. They're still trading down, and most portfolios are struggling. And that's the scenario. So we've been in this for several years. I think we're going to resolve to the downside when the time comes, but sometimes a stage three could last only 3 or 4 months. Other times it can last 3 or 4 years. It really depends on the market environment. And again, the stage analysis works in all time frames. You can trade it on the 1 minute chart, so you can go through the whole wave and the cycle. But when it comes to major bull and bear market cycles, generally it takes a year or so for these major tops and bottoms to form. And there's lots of volatility, like you see on this chart. Like obviously, the majority of stocks have been falling 30%, rallying 50%, like back and forth. That is the sign of a stage three. Because of that volatility, we step back and carry more cash and don't deploy the all-in, all-out methodology, like you said, because it just carries more risk. I value my capital, value my lifestyle more than trying to just swing and take a huge gain, because if it backfires, it hurts. So there's times when you really want to expose yourself more to risk, and there's times when you should just sit back and just be like, okay, this is chaotic. I'm just going to, enjoy what's going on and lower my exposure to all this noise.
Some people go all in on the markets, but they hedge, meaning let's say they're 100% deployed, they have no cash, but part of their positions are, let's say, in long-dated put options, for example, while most of their positions are long SPY, for example. I'm just, throwing out one example. How do you take that approach at all?
No, and I take the total opposite. I think hedging it's a huge cost. So first of all, you're diversifying. You own something you hope goes up, but you also own something that you are in a way hoping goes down. If it goes down, your put option will make some money to help offset it. But
Hmm.
once you start hedging, you've now neutralized some returns. And putting on a hedge means you need to spend money. You're risking money. It's going to cost you. I would much rather, if the trend rolls over, I would move out and move to a cash position. That way you're still earning and making your 4.5% interest a year with no downside risk. And then if the market does turn down, then you move to a position that is actually going to profit from falling pricing. I've never been big into hedging. I used to do it a long time ago, and I realized, what the heck am I doing? Why, if I think it's going to go down, why don't I just get out and avoid it, or benefit from the fall? I don't want to just throw up more positions and just have a big, whack of hedge positions that neutralize everything. So I see hedges as just a pure, it adds complexity, it adds cost, and it reduces your potential profit. So I don't see really many benefits from my perspective to do hedging.
Is seasonality an important factor for you as a trader? Does it actually have any merit in the trading world? For example, we're now entering summertime. Summer doldrums is a term that I've heard for many, many years. Has that
Mm.
actually been observed as a real thing in trading?
It has zero input to our trading strategy. I simply share um, where we are seasonality wise. It's more so just for people to understand where we are on the average stock market cycle. Like, should we be expecting kind of on average price to be kind of sideways or down? If you have that in your mind, then you're not like always thinking the market's going to take off, it's about to take off. People, if you can set your brain with the proper expectations, then you're not always like itching and thinking that every day is going to be the start of the next rally. That's the biggest thing I think I've found I struggle with sharing in interviews and talks about my analysis, is because I share what I think could happen, so people are mentally prepared that we could have a big recession, or that we could have a big breakout. But I don't actually trade that way. I just strictly follow the price. So I mean, I think most of the game when it comes to trading is understanding what the expectations are, and not getting caught up in what you think or feel, but to actually do what the charts are doing. And so I always try and plant the seed, like, listen, we could be going into something ugly. You
Right.
better have an exit strategy. Right now, the stock market, like when we look at like the QQQ, for example, and we just go to the daily chart, uh, obviously we're in a long position. The QQQ is kind of grinding its way up and to the right. It has a bullish pattern. It is on the verge of a big strong rally, like it's going to extend to like 5-6% here, or it is going to roll over and probably have a big correction. And when you go and you strip the markets down
Hmm.
to just raw technicals of price, you should be long the market because it has moved up enough that you should be long, and you should have profit targets set. So if it does take off, you're going to be locking in gains, and you have to have an exit strategy that if it starts to roll over, you need to get out. And I think that's the big thing that people struggle with, is they hear me say one thing, like I'm bearish on the markets, but I'm long. And my opinion is to try to protect people mentally, to be like, you should expect a big drop. I think this market is going to drop any day, and it's going to change its trend, but it doesn't mean we're exiting the trade. I don't know if that makes much sense, but that's the big struggle, is people seem to read a headline or hear me say I'm bearish on the economy, it's going to be a terrible 2025, and then they see me long the markets and they're like, what are you talking about? You're not even, so that's the confusion, is people can't separate the opinion versus the technicals. And that's what I try to explain.
If a new investor or trader were to come to you and say, "Hey, Chris, I've noticed, and based on the research that I've done, I've noticed that historically, November has been a good month for the stock market. December into the Santa Claus rally has been a good month. April has been a good month, mainly because of earnings, for example. The well-known adage, sell in May and go away, has indicated to me that the summer months have usually been quieter. So I should just follow the historical pattern, invest in the months or trade in the months that have a lot of volatility or have historically done well, and just, take a few months off in the summer." Is that something that makes any sense to you?
Not really, no. This is the average, right? The markets really don't move that closely to this. 2 years ago, the S&P 500 moved exactly like that. You could pretty much overlay the chart. It was crazy. Last
Hmm.
year, it didn't. It was very different. the markets are not that simple. You can't just throw an average over and be like, okay, I'm going to sell at the beginning of June, I'll buy back in October. Yes, it will work to some regard, some years, and some years
Because
it'll
if it
work
works every single time, it would be too easy.
100%. Yeah. What is it? Yeah, it works 100% of the time, 60% of the time.
I understood that reference. Okay. All right. So you don't take seasonality into account. Fine. Let's take a look at dividend stocks. You're telling me offline. Well, you said in the last show as well that you didn't like dividend stocks in particular. Some people might be confused at that. Dividend stocks are good. They're good for cash flow. What's there to hate?
Yeah, so dividend stocks, they are good for cash. There's a time to own dividend stocks and a time to not. And I actually did a
Yeah.
talk about this a few days ago with some members. But long story short, if we take a look at this ETF, SPYD, now this is the high dividend S&P 500 stocks. It's clearly in a distribution mode. We have heavy volume selling. Then we go into a bear flag pattern. Then we have more heavy selling. And now we're back into kind of another kind of bearish pattern. It has a series of lower highs and lower lows. What I don't like about dividend stocks in this market environment is when and if we go into a big bear market phase, the majority of people who hold these stocks are 50 plus retirees. And the problem is they all have the same concerns, thoughts, and feelings. They're all worried about running out of money in retirement. They're worried about their
Hmm.
portfolios going down. They all hold the same stocks. And so all that whole group of money, when they all start to hit the same tipping point of fear of losing more money, they all hit the sell button and they dump the same stocks at the same time. And so I think dividend stocks, they do. It's you go back on the charts, dividend stocks fall way more percentage wise than the S&P 500. People don't realize when we go into a big sell off, people holding dividend stocks lose way more money. In the 2020 COVID crash, for example, dividend stocks fell 40 almost 48%. The S&P 500 fell 34%. So people are going into dividend stocks thinking, yes, they get yield, they get a couple extra percentage points, but they also lose way more money when the market falls. And that's because the same group of people all panic for the same reason at the same time, and they kill the stock price. The chart on this, when you look at the price of what dividend stocks are doing, does not look very healthy. If we look at energy stocks, which is a good contributor to this, we've seen energy stocks break down through this level. They have what looks to be a giant bear flag that I think eventually is going to roll over. And the energy space, which you and I talked about several months ago, I believe is going to be a great inverse trade. Like you buy an inverse ETF on this sector because I believe it is going to have a huge sell off to the downside. We're going to see a massive unwinding in the energy space. Dividend stocks, a good chunk of these are dividend stocks. And if this sector is about to fall, dividend stocks, dividend funds are going to fall. Another one is the real estate market. REITs pay out lots of dividends. It doesn't have a very strong chart pattern. Obviously, it's a series of lower highs, lower lows. And when the stock market collapses and crashes, we tend to see the REIT ETFs sell off. Obviously, 2022, we saw it fall 43%. In 2008, it fell a lot more. It fell like 70 or 80%. And, people look to real estate and REITs for that passive income, that rental income, but the stocks get hit really hard. So the time to get into dividend stocks is after a financial reset. Right now, they carry to me actually some of the top risk, really high level risk. They are a ticking time bomb, as you and I referenced it once before for retirees. The time to hold them is like after a financial reset. I bought into a Canadian ETF. It was a dividend ETF in 2009, right after the financial crash. It was paying 16% dividend. It then doubled in value over the next year. And if you just kept holding it, you'd be making huge dividends, probably like 25, 30% dividends based on your original investment if you held on to it. That's the time to get into dividends is after a financial reset, not right now where there's a ton of downside risk. And eventually, if we go into a recession, dividends are going to start to get cut. And once companies start cutting dividends, the share prices drop dramatically
Hmm.
because there's funds and institutions that only invest in companies that have dividends that are holding value or increasing their dividends. But as soon as companies start cutting dividends, they get ditched out of funds, which means tons of shares have to be sold. So, anyways, the dividend space, unfortunately, is where most investors have their money. They think they're big, solid companies that'll be okay, but they're not. They are solid companies, but their share prices still get hit. Share price and quality of the company don't really go hand in hand. Strongest company can still have their share price fall 50,
Right.
60% just because investors get scared and they dump shares.
By the way, you mentioned once the recession hits. Suppose a recession doesn't come. I'm not saying it will or won't, but I'm just wondering whether or not you're going to change your strategy depending on whether or not we still get a recession. Some estimates um, are now coming in for no recession at all.
Mhm.
And continued growth, and it really depends on how bad these tariffs can get,
Yep.
partly. But anyway, we can't predict economic growth. But let's say we have confirming signals that we have multiple quarters in the next year or so of positive GDP growth and things aren't slowing down. Would you change any of your strategies or your outlook at all?
Yeah, for sure. That's the nice thing about the strategy that I follow, which is the one with the red and green bars that I've shared there. My ACS strategy, it follows the price trends. And the nice thing is it gets us in early when a new trend starts, and that trend, and we could be in a bull market for years. When the market rolls over, it might just be a correction, or it could be the start of a bear market. It really doesn't actually matter what market we're in because we follow price. Obviously, if we break to new all-time highs and we have strong economic data, we've got manufacturing numbers really strong and all that stuff, then we could just kick right back into a bull market phase. The nice thing about the strategy that I follow is it's always jumping on to the most current trend as long as there's strength there. So we could break into a bull market, and obviously that will negate the bearishness. Right now, I still see the bearish picture, and typically this is what happens: is people start to get bullish, as you just said, David, and people start to um, more or less just get overly bullish just before a major top. And that's what the
Hmm.
market is really good at. And that's why, in a way, I want the stock market to hit like the S&P 500 and the NASDAQ to hit nominal new highs. If we can poke to a new high on both of those for a day or a week or even a month, uh, that could be just the what we need, the catalyst for the rest of the money that is going to get involved to move into the stock market and create that little bit of a top, a pop, a push, a little blow off top. And then we go and we see huge distribution selling. Typically, it takes a little bit of a nudge. The market loves to throw people offside right at the last minute, suck them into a trend, and then reverse. But you're right. My analysis could totally change if we get strong economic data and overall the broad market starts to rally. Because still, right now, the whole stock market as a whole really isn't moving. Most stocks are struggling. It's just the big techs doing a lot of the heavy lifting that make it look like it's a strong market.
Well, let's finish off on Bitcoin then. Is Bitcoin still following the stock market?
Yeah, Bitcoin is definitely struggling. Yesterday, we saw the Nasdaq, we saw Tesla get hit. If you were to overlay the intraday charts, they pretty much moved down together in sync. Yesterday was a news-driven event, and as I always say, if something happens on news, you can't trust it. Meaning, a huge drop on news is usually going to be negated, bought back, within a session or three, and that's exactly what's happened so far. The market, I would say, here has been pulling back into a bull flag pattern. I would say that news move created a bit of a flush out low. We see this happen all the time. The markets will sell off, have a quick drop, and then reverse and then shoot higher. And most people bail out at this phase. This is the shakeout that gets people out. So to me, this is actually a very bullish sign for Bitcoin. Hopefully, we get follow through for the next few days. I think the stock market is going to try to push a little bit higher, and I think Bitcoin is going to go higher with it. And yeah, you still want to be long Bitcoin. We're long IBIT, which is the ETF that mimics Bitcoin, and I think it's got potential for some more upside here.
Okay, excellent. Chris, tell us about your strategy in more detail and how we can find out more from you and learn from you.
Sure. Yeah. The best way is you can go to my website. You can see what I do, join our free newsletter, or go to my YouTube channel, The Technical Traders. More or less, what I do is I share what's going on in the markets, so you're mentally prepared for rallies and sell-offs. The strategies that I've been showing here with our red and green bars to move away from markets that are rolling over is our asset revesting strategy. So this is how do we just hold stocks when they're going up, move to a different asset class when the stock market's falling, and go through there. So this is the asset revesting strategy where I trade ETFs. We have both 5 to 12 trades. We just rotate our portfolio through those. And then, of course, if you like technical analysis and you want to understand overbought, oversold market conditions, you want to identify trends, you want to know when there's panic selling or FOMO buying going on in the markets, this book shows that in chapter 10, 11, and 12. And those indicators are pretty cool. They're these ones here on this 30-minute chart. It tells us when, we just go to the S&P 500, it tells us when we get into these oversold levels, when we get panic selling spikes in the market, tells us when we're in an oversold level. We have these short-term FOMO waves, tells us when the market is putting in a short-term high, you should expect a pullback. We have some FOMO early this morning already, as you and I are talking, so I would expect some more noise and pullback, but you can identify and trade these moves with the technicals from there. So that's how people can follow me, either book, website, or YouTube.
All right, let's put the link down below. We'll make sure to follow Chris there. Thank you very much, Chris. Have a great trip. You're heading out. So we'll see you when you get back from your trip.
All right. Thanks, David. Appreciate it. Take care.
And thank you for watching. Don't forget to like and subscribe.